So once again, everybody, welcome to Hot Forex. Apologies for that spelling mistake on that first slide there. My name's Stuart. I'm one of the analysts here at Hot Forex, and we're going to talk about algorithmics and system trading today. Brief explanation of what I do, how we approach trading here. But before we get going, let me just quickly run through the disclaimer. This material is provided as a general marketing communication for information purposes and does not constitute independent investment research. Nothing in this communication contains or should be considered investment advice or an investment recommendation or a solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing an indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that any investment in FX and CFD product is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our written permission, prior written permission, in fact. Okay, so welcome everybody. As I say, any issues with the webinar, try restarting GoToWebinar, the software, or your local internet connection. Sometimes we have problems at this end, obviously. But those of you that don't know me, there's lots of people in today, quite a few new names here. My name's Stuart. I'm in my mid-50s, I suppose, now. I've been trading my own money since September 1997, and I will tell you the story about that today. I won't spend too long on the story, but it's significant for me and my family, and it went click in my head August 1997. And I've been using my own money since then, nearly 20 years now. And over that time, I would distill my experience and knowledge down to 4 things. It doesn't take 20 years to come up with these ideas, but really for me, it's all about do something that's probable. If it's probable, do it. If it doesn't seem probable, it's only possible, don't do it. Wait for the next opportunity to come along. Don't overcomplicate things. You know, I've had many times when my chart has just got cluttered with too much news in my head, too many indicators on the screen, and I just, I was paralyzed, analysis paralysis, somebody once called it, and that's exactly what happens from time to time. I also like to look at multiple time frames. So for my trading, I tend to trade at the end of the day when it's all peaceful and quiet, or it's early in the morning, markets are quiet, and allows me to think. But I also like to know what's going on in the lower time frame, so say the 4-hour or the 1-hour time frame, the intraday stuff, to see how that's going to affect my time frame, my trading time frame, which is the middle one, which is the daily time frame. I then am interested in what's going on in the weekly and the monthly. So is the weekly in an uptrend or a downtrend? Is it going sideways? Is the monthly in an uptrend or a downtrend? So multiple time frames, I'll look at that, and that's a whole webinar in itself. But the most important thing is to know yourself. And again, anybody that's heard me talk before or seen any of us, been to any of our seminars and seen me talk live, I talk about this all the time. It's all about risk management. It's all about knowing yourself. Money management, keeping things simple. Don't get greedy. Don't get scared. Manage being scared and manage being greedy. You can't get rid of it because emotion, they say emotion kills good trading, and it's absolutely true. But we're human beings and we're emotional people. So some people say, oh, well, that's what algos do for you. That's what systems do. They get rid of all the emotion. Well, yes, they do. But algos and systems are still programmed by people. Artificial intelligence is happening and will happen and will probably take over financial trading. But not why I'm still alive and kicking, I don't suppose. But it will change definitely. But at the moment, markets are driven by people and emotions. Fear and greed, the 2 key things that drive the markets, and you've got to know yourself. You've got to accept losing. So today we're going to look at algorithmic trading. I'll put it in its place. It shouldn't be anything we should be looking at or interested in, to be honest. Please tell me if you think otherwise. This is only my personal opinion, and I'll tell you the history of it and some things that go on. I talk about discretionary and non-discretionary systems, okay, when we talk about systems. So I'll look at my system and how I find thank you, Omid, finding and entering trades, setting targets, setting stop losses. Oh, Omid, I won't read out what you've just written, but I appreciate your comment. It's made me smile. Mindset, discipline, patience and risk management, all very boring words, but all part of a good system and a good trader. Mindset, you've got to have a clear mindset. Discipline and patience, I bang on about that all the time because nothing's changed in the trading world. Even long before I started trading and long after I stopped trading, all these things will still be relevant. Patience, risk management, money management. And then we'll look at creating a system, what makes a good system, and obviously your questions either at the end or as we go through today. Okay, so algo. So what is algorithmic trading? Let me tell you what sorry, before we get going, let me just recap my approach, and this is my mantra, this is my philosophy. Trading is all about you, not the markets, not listening to somebody like me or watching the webinars or looking at YouTube videos. Or it's about you understanding yourself. And the most important question you've got to ask yourself: can you accept a loss? Can you accept a series of losing trades, both on your financial system and your financial account, as well as your emotional and psychological makeup? That's really where you look yourself in the mirror and ask yourself that. So it's all about having a system that works for you, fits in with your time scale and your lifestyle. Add in a bit of patience and a bit of discipline. Protect your capital. Understand some simple numbers and think in probabilities and percentages, and you're a long way there to be hitting a home run. Successful trader gets you off. I talk about the baseball analogy quite a bit, getting off first base, and if you want to get round, hit a home run. Many people get stuck on first base and end up emptying their account and never coming back to give it another go. You've got to accept losing, a bit of patience, understand the basics, understand margin, understand leverage, understand lot size and how they can all work for you as well as against you. 2 books I strongly recommend. Any of you that heard of me before: The Reminiscences of a Stock Operator and Trading in the Zone. One's by a guy called Edwin Levert and the other one's by a guy called Mark Douglas. They're both free as available as PDF downloads, so you don't even have to buy the book these days because they're that old. Reminiscences was written in 1923 and Trading in the Zone was written in I think the year 2000. One's about psychology, one is a story of one of the world's legendary traders, Jesse Livermore. 2 books I would strongly recommend you read and reread. Then I'll talk about what I do, how I do it, and systems, and as I said before, what makes a good system. So algorithmic trading, what is it? Well, dictionary calls it a black box or algo trading. It uses very advanced, high-powered computers, very complex formulas and mathematical models to make typically, not always, but typically they're very high-speed decisions and very high-speed trading decisions. Some of them very small, some of them huge, but multiple trades, one after the other, or all at once. And most algorithmic tradings are developed by a new group of traders that have appeared in the last 5 or 10 years called high-frequency trading companies. Companies like Constellation, or ultra-high frequency trades. Millisecond trades, many of them, and all computer generated, all driven by price action only. So to do this, you need super fast computers, programs, complex algorithms, very clever guys to write these codes, creating strategies, and obviously strategies that generate returns. Because any strategy, any investment plan obviously needs money you risk and money the return that you make. So these are all heavily dependent on mathematical formulas, statistical techniques based on previous price action. Okay, all done typically, but not always, very quickly with multiple trades. And because of that, true algorithmic trading is the preserve of the big banks or the big institutions, due to this massive capital investments required both in people and resources. So they need the best of the best PhD mathematical graduates around the world, and they scour the world for these best brains. They need huge and fast computing power, better than their competitors, and that's what they do. Now remember that this market, they're competing with each other as well as the rest of the market. So true algorithmic trading is really the preserve of the big guys. Okay, so don't really think you can sort of even try to think it. You see algos all the time up on or EAs as people, the slower ones we see here. But remember, you're competing with these ultra fast, high edge big institutions with billions of dollars behind them. Okay. So why do we do it, or why do they do it? There's 4 principal areas where algos and these high-speed markets work quite well, or they apply to work. They work very well in the arbitrage business. So if you're looking for the difference between the spot price and the future price of a contract, they work quite well on. They work very well on this one here, this trading before index fund rebalancing. What does that mean? Well, every quarter, the big index funds and the big investment teams have to invest for long term. So every quarter, typically, like it's about to happen today on the FTSE 100 in the UK, some companies are too small to be in the FTSE 100, so they'll get taken out. Other companies have got bigger, so they get taken out of the FTSE 250 and they get put into the FTSE 100, and that rebalancing is done every quarter. And what these algo systems can do is predict and guess, or look for the companies that are likely to be dropped out of an index and likely to be put into an index. The problem with the big investment companies is that they've got to trade these big indexes. So they can't sort of not be exposed to them, and they can't change their allocation until this rebalances happen. So they'll trade on these companies that are coming in and going out. Again, usually very quickly, and you can see that's why sometimes you see some very strange moves in some of these companies that are being moved into an index or out of an index. So this happens all over the world. I'm using the UK FTSE as an example because that's what's happening today, but it happens in the States, happens in Asia, happens all over the world. Okay, so index fund rebalance is what they do it. They're also really good at mean reversion trades. So where you have a standard, a movement away from the standard mean. So if you're too many standard deviations from the prices move too far away, so a bit like the Bollinger Bands, looking at that they're good at those, looking for turns in the market as well. But what they're principally used for, which I suggested earlier, is they're principally very high frequency, ultra high frequency, UHFT there, for scalping of micro seconds, both on Forex, but more usually and typically on equities and commodities. It's where most of these high frequency trading companies exist, in that area. And I'll just they tend to, they're not only trading against each other, but they're trading against some of the bigger players. So if some big traditional stockbroker or bank has a big order for a certain commodity or equity, they will sense that in the market. That's how their programs work, and see lots of trades coming out, lots of certain sell positions or lots of buy positions out of a certain institution over a certain period of time, and they see these patterns form, and they try to what they call front run these trades, these very quick scalping decisions. Okay, so it's very much a big player, big institutionally driven business, algorithmic trading. Okay, so don't let anybody try and confuse you about what algos are or aren't. The algorithmic trading I'm talking about is the top end of the market, big numbers, billions of dollars through the big institutions and the very big banks. Okay. So it's very Michael Lewis wrote, it's one of my book lists here, wrote a great book about it, Flash Boys, and it's all about the high frequency trading companies and how they were skewing the market and betting against their own clients, and how a team of oddballs, as he calls them, created the IEX exchange eventually, and to sort of even up the game and put in some speed bumps to slow down some of these orders that were going through, and front running lots of the orders of their own clients in the big banks. So if you're interested in finding a bit more about algorithmic trading, just the background of it, I strongly recommend you have a look through the book Flash Boys. Great book, and will make a great film if they ever get around to it, much more so than perhaps The Big Short, his other famous book and film. So systems, so that's algorithmic trading. So systems are typically two types. But before I say anything, preamble, no system can be perfect, will be or can be. Okay, you've got to accept that. So it comes back to my very first comment about accepting losing, and accepting losing 3, 4, 5, 6, 7 times in a row sometimes. Whether you've got a system or you're doing it on your own as a intuition discretionary trader, you've got to accept losing. So there isn't such a thing as a perfect system. I don't know very many, in my 20 years of trading and working in the city and other areas, I don't know very many good discretionary traders. I've heard of a few. I don't actually know any of them personally. Sorry, somebody's asked a question. Is it legal? Yes, it is legal, Nagwash. High frequency trading and ultra high frequency trading. Yes, if you Google HFTs or ultra or high frequency trading, yes, it's not illegal. It's you could say it's unethical and amoral, but it's not strictly illegal. Although some of the stories that have come out, some of the banks do seem to be trading against their own customers. And when you hear about, sorry, I'm going off the point here, but sometimes you also hear about a thing called dark pools. That's sometimes what the very big banks, the Citibanks, the Goldman Sachs, they'll have their own interbank deals that is not open to the exchanges, not open to the banks. So they'll be trading between themselves and against each other in this dark pool area again. So if you want to know, more about high frequency trading, have a look at that book Flash Boys by Michael Lewis, and Google high frequency trading in its broadest sense, but also have a look at Google what dark pools are as well. And there are a number of key big high frequency trading companies. Say Constellation is one of them. So sorry, just come out. So there's two types of systems, like a discretionary system, which is basically the intuition of the trader. As I say, I don't know anybody personally that does that. I've heard all sorts of stories about people that were good at it. They could sense the market. You could have one guy just looking at a screen. He could say, well, that's going to go up. No, not for any particular reason, and it did. Again, how many of these are stories and these people really existed? To be honest, I don't really know. But for me, I'm not good enough like that. I haven't got that intuition. I need to be, a bit more rules based. It's very easy to lose your money trading, whatever you're trading, whether it's stocks or a forex. So a non-discretionary system, and most successful systems are these non-discretionary systems. And what do I mean by that? Non-discretionary means they take the thinking out of it. Okay, they're rules based a bit on the maths and the algorithms we talked about before, but they take in things like different variables and different parameters. They avoid 100% emotion. They're rules based ones. They take as much of the emotion out of it as possible. They tend to, good systems tend to be back tested on old data. To be honest, personally, I'm not a great fan of back testing, and in my view, too much reliability, too many systems fail because they don't predict the real world. They're based on lots of data that's already happened rather than real spreads at real trading times. They're looking at old data that's cold. But the beauty of back testing, it gives you this confidence and consistency. So if you've got a rules-based system and you back test it and back test and test it, that's great, but you want it to be very successful, because another famous quote here is, the worst is, no matter how much back testing you do, the real world will always bite you on the bum, to quote a very English saying. So the real world is always, the worst is always ahead of you, not behind you. So if you've back tested your system on old data for the last 5 years or 10 years and you had a big drawdown of 15%, you might want to think that your system in the real world might have a drawdown of 20%, 25%. Can your system cope? Can your account cope with that? Can your margin call cope with that? So always, the worst tends to be always ahead of you. And one old analogy to put that into context is half your profit and double your drawdown. So if your system made a drawdown of, say, 15%, assume it's going to make 30% of a drawdown in the real world. If your system made a 15% profit, assume it's only going to make 8% in the real world, and see if it still works out, if it still balances, even with all that back data. And again, the problem is that most people don't do that. We don't want to see our system failing. And again, it's all about the psychology, and that's why understanding yourself and understanding the market is far more important than having a great system, to be honest. Because even people with a good system can still end up emptying their account because their risk management and their money management and their accepting of losing beats them in the end. And you see that time and time again. I've seen that many times as well. So think about, back testing's great, but the worst is always ahead of you, and half your profit, double your drawdown. Okay. Any questions so far? No. Good. Right. Quick story of how I got started trading. It all started on a Sunday morning. It was August 1997. I had a hangover. We were about to go. We'd had people round in the house. We'd had people visiting. Saturday night, people were coming for Sunday lunch on Sunday. The two children were downstairs watching the TV as normal on a Sunday morning. But Jessica, our eldest one, came up and prodded us in the side. I had a bit of a thick head because I had too much to drink, and she said, Dad, the Rugrats aren't on. Rugrats was a cartoon series back in the 90s that certainly Jessica, our eldest one, really liked. And I said, go away, come. And what seemed like 30 seconds later, she was back up pestering her mum, saying, there's just news on everywhere, Dad, there's news on everywhere. So I went downstairs, and she was right. The Rugrats weren't on. It was August the 31st, 1997, and Princess Diana had died. She'd been killed in a crash in Paris. I'm sure you all know the story. But for me and for our family, that had quite a big impact on us. And the reason was, she was not only was she a princess, and she had a very a privileged life, and she was obviously very rich and had everything she wanted, but she'd had a very sad marriage. But more importantly, she was the same age as me. She was born in the same year. She had two young children, two young boys that she had lost their mother that day, and that had a huge impact on all of us as a family. We never actually got to church that Sunday. We just sat there and watched that news running round and round and round. And honestly, it was that event that triggered. I'd been thinking about trading for many years. I was working for myself at that point, and I had the money to do it, and if I'd lost it, it wasn't going to change our lives particularly. So it was that milestone moment that happened that got me going in trading. I'd always been interested in it, but it was that kick-started me. And it was a horrible event, but it made a huge difference to us and our family. So you've got to decide. You've got to decide why you're doing this. Have a plan. For me, it was to obviously to help my family, pay for school fees, pay the mortgage off, all that sort of thing. But have a plan. You really do need a plan. Which says I have a lot in common. I also trade in bed since a year ago. Okay. Well, no, it is a story, but I remember sitting there on the settee with the kids and my wife, and it was just a big moment that said, let's get your finger out and do this. You've been talked about it for years, and I say I was nearly 36 before I got started. The beauty of forex trading now is that anybody can do it from anywhere in the world. 97, I had a very big, thick laptop computer. It was probably about 3 or 4 inches thick. It was so heavy. Now you can do it anywhere. So anyway, what do I do? This is my system. I tend to trade off the daily time frame. So I wait for all the noise of the day to calm down. I also have a system that uses 4-hour charts and 1-hour charts in the intraday system. It's very similar. It doesn't change that much. I look at 38 charts very quickly. I scan them either manually or I have a little scanner on my little trading platform. Excuse me. So I trade the main forex currency, so obviously the dollar, the euro, blah blah blah, up to the New Zealand dollar. So the 8 major currencies, that gives me 28 crosses or 28 pairs. Then also I look at oil, the two oil Brent and WTI, or UK oil and US oil. Commodities, I'll look at 3 in particular: gold, silver and copper. They're similar but different. They all have different things that drive them. And then indexes, I'll look at the Dow, the S&P, the FTSE, the DAX, and the one I always have open as well, but I don't really trade very much, is the US dollar index, just to see how the US dollar's doing. So the USA 30, the USA 500, the UK 100, and the JER 30, or the DAX 30 as we got it got it up there. So I will wait till London closes, because my system's based out. It's a UK system, based on UK time. So it tends to be 12 o'clock midnight where I am here in Cyprus, or 10 o'clock UK time. I'll either run my scan then, but typically I'm in bed by midnight. So I'll do it first thing in the morning, usually about 6 o'clock or 6:30. So I'll do it then, see what's happened. So the movement overnight, and I said either ignore, or if I've missed a big move, that's just part of the deal. So I'll run the scanner, or I'll look at it manually and click through them myself. It might sound a lot, 38, but sometimes I'm just looking for some changes, so it doesn't take very long at all. And if the system says go, I tend to go. So I open it and I call it a leave it alone, or set and forget, some other people call it. So I put it on. I always trade with a stop loss, and I always trade with a take profit, and I cannot emphasize that enough about whatever system, whatever approach you take. Again, I can't tell you what to do, and I can't recommend what to do, but I tell you what I do. I always trade with a stop loss, and I always trade with a take profit, because it takes 90% of the emotion out, because you've made your decision before you risk any of your money. You know where you want to get out, you know where your top take profit wants to be, and you know where your stop loss is, so you know how much you're prepared to lose. And if that loss is small, you live to fight another day. And that's item number 6 there, risk management, absolutely vital. And if I could talk about it at every single webinar, I would. So risk management, so I tend to manage it by lot size and risk. So I'll tend to risk on each trade that I have opened between 1 and 2% of my equity. Okay, and I'll vary the lot size accordingly. Obviously my account size dictates what I can do. Robert's asking, you mentioned scanner, what is this? Robert, it's just a simple scanner that's been written with my system, that's all, and it just automates looking through the 38 charts, looking for what I'm trying to, or 40 charts, whatever it is, that I'm trying that fits my criteria, and I'll come on to the criteria in a minute. Okay, sometimes, point 7 there, sometimes if I trade with a multi-target, sometimes you'll see me writing about target 1 and target 2, I will risk or anticipate closing 80% of the trade at target 1 and 20% of the trade at target 2. And I do that in 2 different ways. I'll either put 2 trades on instantly at the same time, not instantly, but virtually within sort of a few seconds of each other, and then put the stop loss and the take profit on later. Because remember, I'm looking at daily trades, so it doesn't matter if I miss a few pips getting in or getting out, because I'm looking for a bigger pip move. Or that's one place. I'll put both trades on at the same time. Or as I've started to do recently, is just risk 80% of my the risk, the whole risk, on getting to target 1. If it gets to target 1, then open a second trade with 20% of the risk of the first trade, and let that run as well. But just, so there's 2 different approaches there. So daily charts, a set and forget or leave it alone basis, always a stop loss and always with a take profit. And manage your exposure at any one time to 1 or 2% of your account. And I tend not to have, this month I've had 10, 12, 11, 13 trades I think I had opened at once, which is a lot for me to risk. If they all went wrong, that would be nearly 20% of my account gone. And that's how you have to think, and that's how I think all the time. The likelihood of them all going wrong is quite small, but things like that happen. So that's what I do. I'm not saying it's right or wrong, but it works for me. Okay, so my system is all about energy in the market, and you'll hear me talk about this all the time. So I'm looking for flows in the market, waves or whatever you want to call it, whether you're doing Elliott wave analysis or M's and W's or flows in the market, whatever it is. I'm looking for that energy and that momentum in the market. So it's very much a trending system. And I'm looking for turning points in the trend, so at the end or the beginning or getting in at the middle of it. And it's very, very much a rules-based, non-discretionary system. So this scanner thing that you asked about, Robert, is based on a lot of these things I've got here. So it's typically, I'm not going to tell you exactly what it is, because it's mine and I've spent tens of thousands of dollars developing it. But it's typically, I like the 20-day simple moving average. And again, if you listen to me or watch me write stuff, you'll see me talking about it, the 20-day moving average being breached or broken. So it gets to it, but for me, it's really got to have the energy to get right through it, or it's already got right through it. Okay, so you'll see me sometimes either opening trades just before the 20-day moving average or just after, or long way after sometimes. It all depends how the rest of the market's trading. I look for my take profit at about the 14 period ATR, the average true range, or the 14-day ATR on the daily time frame, and that's usually where my target is, or a multiple thereof that. Okay, so it's usually at least one. Whatever. So if the ATR was say 50, that would be my 50 pips. If that 50 came to a key level, or 60 took it to a key level, I would tend to use 1.2 or 1.3 up to 1.5 of the ATR sometimes. And again, that's a bit of discretion that comes into my non-discretionary system. So you see, even I are fiddling with things from time to time. The stop loss is very simple. It's got to be where it's got to be. And if it's a long way from where I get in, so be it. And quite often, what my system has shown me over the years is that this sounds a bit crazy, this, if you're new to trading, but sometimes the trades with the biggest stop loss compared to the target have a higher percentage of hitting their target than those with a closer target. A closer stop loss and a closer target. I hope that made sense. Let me say that again. What my system has shown me is that sometimes I can have a very big stop loss relative to the size of the target, but the rules and the maths over the years has shown me that they have quite a high chance of actually reaching their target. So the other things I like to use manual support and resistance, so drawing my own lines on the chart. I like Bollinger Bands, I like Fibonacci retracements and fractals, and I also tend to have the RSI. So anytime you see me posting charts, it'll tend to have those sort of things on it. Bollinger Bands, occasionally Fibonacci, usually fractals and RSI underneath, based on the 20-day moving average, which is the centre band in the Bollinger Band, and support and resistance levels. That's basically what my system does. I don't really trade channels. I will occasionally if it fits. I've got a webinar at the end of June where I talk about flags, pennants, channels and all that sort of stuff as well. We'll go through that in a bit more detail then. But my system is very much a trend-based system. So I'm looking for turning points and following a trend, breakout system. So that's why I like moving averages and Bollinger Bands. So again, any of you that know anything about indicators, you can see all these indicators here I'm talking about are very much trending indicators. Okay, I'm not great with oscillators, to be honest, but they obviously have their place, and the market goes sideways more often than it's trending. It's just the way I do it, and I'm not saying it's right or wrong. It's just what works for me and fits with my time frames and how I trade. Okay. OMID, no trading channels, no. 100 and 200 day moving average also very useful at daily charts. Yes, absolutely. So moving averages, yes. So I'll tend to have I tend to actually use the 200 and the 50 rather than the 100, to be honest, OMID. But again, whatever fits. So well, 200 more than the 50 sometimes, but certainly the 20 obviously is the middle point on the Bollinger Band, and the 200. For the intraday system, the one I said before, I said I had the 4-hour system as well as the daily system. Well, the 4-hour system is very, very similar. It just, instead of the target tends to be the ATR again, but it tends to be usually less than the ATR, and then because it's an intraday system, the spread becomes an issue as well then. So I'll tend to either take the spread off or add the spread on, depending which way I'm going, whether I'm long or I'm short. Okay, so 4-hour system is very, very similar. ATR still is a target, but the spread comes into account. And then when we come down lower to the 1-hour system, obviously the ATR 14 period ATR can be quite short, so the spread is even more important then. So it just tends to be on the major crosses with the tightest spread on the 1-hour system. Okay. So how does it work? Well, it works okay. This is based on, if you weren't here yesterday, this is how we've done in May. 28 trades. We're doing all right with 2,300 pips up. Some big winners here on gold and silver. Obviously, that's been skewed because of the pip count, so not necessarily the pip count, but we've won 53%. We've won more than half, I think. So we're doing okay, and we still got 6 or 7 trades open. We took another 2 this morning on dollar yen on the 4-hour and the 1-hour trade, so we'll see how May ends up. So that's that's me, that's what I do. This is our results so far this year. Again, sorry to bore you if you were here yesterday, but I do like blowing my own trumpet because we're actually quite good at what we do here, and this is all free. People charge you thousands sometimes to listen to stuff that we give away for free, but there you go. 213 trades or posts I've put up, or we've put up since March 16th, 2016. 68% of them won, 32% of them lost. In anybody's goal, that's not doing too bad, is it? So there you go. So systems, I'll come on to that. Some questions coming in here as well. When your T1 hits, do you change your T2 trade stop loss to enter point, or do you risk free it? I should do that, Babak. That would make absolute sense, wouldn't it? What tends to happen with my T1 and T2 is if the trade's going to hit T1, it tends to retrace quite aggressively from T1. Sometimes it goes back to my entry point and I'm actually out of the money, so I will tend to close it down. I tend not to move the stop loss, to be honest. I should. It was like yesterday. Any of you that were in the webinar yesterday, I was looking at. We've got a dollar Swiss franc trade on that's gone nowhere, and yesterday I was looking at it live with everybody. I said I'm going to move the take profit down to this fractal high because I'm getting bored with it. It's the end of the month. I want to close this trade, see if we can make a few pips out of it. I didn't. And guess what? It hit that fractal high yesterday, and today it's retraced from that fractal high, and I'm out of the money again. So, I'm not as organized or rigid as perhaps I should be, Babak. But yes, that would be that. I tend not to do that because sometimes, again, history has shown me that the trade gets to T1, it can retrace all the way past the entry point, and then it still gets to T2 over a period of time. But that can take 3 or 4 weeks sometimes, and obviously then you've got costs of holding trades and stuff, but not always. But yes, more often than not, T1, a little retrace, not back to the entry point, but then off to T2, or retrace sideways, doesn't get to T1 at all, and then I'll tend to close a trade. Then again, I'm a human being, I get bored with things and close them off. But I'm happy to go back in and look at those points sometimes as well. So I hope that made sense, Babak, and answered your question. So I'm not as structured as perhaps I should be, but that, again, that's me. Because I'm not as automated as that. So, whoops, what happened then? So, how to create a system? As I said at the beginning, a system's never perfect and never can be. So don't beat yourself up thinking, if I tweak this, if I tweak that, if I change, my stochastics, or I fiddle with my moving average, or I look at my whatever it is, Fibonacci levels, I can find a better way. There isn't. Markets aren't perfect. You're not perfect. They're certainly not logical. I see that all the time. People are always asking me about why this news caused the dollar to go down when it was really positive. Well, that's just because that's what it does. That's what the markets do. The markets are never wrong. The markets are always right. And if you're a winning trade, that's okay. If you're a losing trade, that should also be okay, because that's what they do. They go up, they go down, they go sideways. So, as I say, discretionary traders, very, very rare. They have this sense of, looking at systems. And again, I've heard all sorts of stories about good discretionary traders, most of them retired or dead, but I've never seen any of them myself personally, to be honest. I've heard stories within trading rooms I've worked in that, Johnny over there just stares at the screen once or twice a day and he can get a feel for it. Most who try to do it, most ordinary guys and girls like you and I, we end up losing all our shirt. Because we think it's going to do this. Very, very rare people, discretionary traders. I say my system is very much a non-discretionary system. It's mechanical, it's rule-based, it's emotion-free as much as I try to make it without me interfering with it from time to time. But the key thing is you've got to understand the risk and the risk management of it. Looking at the coding of my system, there's about 30, 40 lines of it. I don't really understand the coding too much, to be honest. But there's about 30 or 40 lines of it that's related to the trading. So looking at the the moving averages, or the change in the certain price levels that day or volumes that day or whatever it is. But there's 155 lines that talks about the risk management of the system. So the actual trading element of it, say, is a few lines, but there's many more lines of code that talks about the money management and the risk management side of things. And that's why I bang on, as I do, about risk management and knowing yourself all the time. And I can talk for hours and hours and hours about that, because that, for me, is without doubt the most important thing to be a successful trader, regardless of your account size. And there's many really good systems out there. A lot of them, some of the most successful ones, you can guess what I'm going to say, are sometimes the simplest systems. You know, lots of very good moving average systems. Again, they're great when the markets are trending. You know, it keeps you in the trend, it keeps you on the right side of the trend. The trick with them, with moving average systems, is on the downside of the two key downsides with moving average systems is they tend to be lagging, so they only trigger sometimes after the move's either, you know, sometimes already over, or they're too late, so they're a bit of a lagging dragging system. And the other thing is, people go hunting, trying to hunt trades out, because remember, the markets only trade about maximum 30 to 35% of the time. So for the rest of the time, 70-65% of the time, markets tend to be going sideways or in channels, waiting to move and waiting to get to this next one, this breakout system. So the longer the breakout systems are good as well, because they wait and wait and wait. But again, you need patience and discipline to wait for the proper breakout and not get caught out by failed breakouts. And again, a lot of breakout systems fail or break down themselves because they don't manage the failed breakout very well. I was going to say something about moving average systems. I forgot what I was going to say there, but anyway, so moving average systems are quite good. Breakout systems can be quite good because, again, you've got lots of energy, because the theory behind those basically is the longer a market consolidates or goes sideways, the more energy it's building up, and so when it does move, the move can be very aggressive and very quick and very significant. So that's those sort of systems, but again, you need good patience and good discipline to wait for those to come. Lots and lots and lots of pattern recognition systems. And again, the thing with pattern recognition systems is that computer systems aren't very good at that. This might sound contradictory, but computer systems are not very good at picking out patterns. The human mind and human eye is actually better at doing that. So these are okay, and you know, when you see the butterflies, the M's, the W's, it's okay in hindsight. But actually seeing it at the cutting edge, the live trade, the live action, the live prices, they're perhaps not as significant as some people think they are. But again, pattern systems are quite good. And as I said at the beginning, one of the key good systems are these mean reversion systems, where we're looking at the overextension from the norm. So moving averages, standard deviation systems as well, so Bollinger Bands and systems that are moving away from the mean too far. They've got too stretched, the market's got too extended from the norm, so it's got to come back. They can be quite effective systems as well. So finally, which perhaps you're perhaps listening for, is what works best. Well, again, looking at lots of good systems and having seen many systems work and fail, if you're putting the systems together, the ones that tend to work the best have, you've got to be looking to make at least 12, 13, 15% per annum. Let's do it. I'm saying per annum because you need to be, you need to run a system that's done, hundreds of trades to get some sort of statistical playbacks, and something you can actually work on. So you're looking for about 15, at least 12%, so 15%. Not have lots and lots of rules. So again, that comes back to the other thing I said at the beginning about try and keep things as simple as possible, because too many rules end up contradicting each other. So again, if you go into any trading site, whatever it is, sometimes you'll see one indicator saying buy, another indicator saying hold, and another set of indicators saying sell. So which one do you take into account? All in the same time frame sometimes. So too many rules, too many indicators can be quite confusing for your system. So try and keep it as simple as possible. As you see, mine is really very much moving average based. I like Bollinger Bands, and I like the moving averages. So I'm very much a trend trader, looking for the changes in the trend. Make sure as well that it's a system that works across other assets. So if you're only looking to trade Forex, make sure you back test it just on the Forex pairs. As I say, my system works really well across commodities, indexes, and Forex as well. So make sure you test it and check it on multiple markets, because some systems can work very, very well with equity markets but fall down in Forex markets. Some good Forex trading systems tend to be quite good with equity trading as well. The equity trading systems are not so good with crossing over to Forex because of the gapping that you can get on equities and indexes as well. Some of them can't take that into account. So again, think about that sort of thing. But again, the key thing, I keep coming back to risk and risk management. Again, I talk about it all the time, as I keep saying. Strong risk control. Expect these drawdowns to be bigger than you expect. So 20%. Typically in any particular lease. Some lot have many more than that. I know a very good friend of mine, a very good trader, who's been trading a lot longer than I have, and I've learned a lot from him. But last year his system was out of money, out of pocket for 8 or 9 months of the year, January through to September and October, and it was only Mr. Trump getting elected that saved his system and saved his year. So his 9 months of losses were wiped out in November and December because of the way the stock market turned around, the way the dollar turned around, the way the dollar index turned around. So he was out of money, out of pocket for 8 or 9 months of the year. Obviously wasn't very happy about that, but he didn't get too uptight about it, and he's a very, very calm, controlled chap as well. Anyway, that's just the way he is. But that's what happens. He's been trading 30-40 years, and he said that sometimes you get drawdown, you get months, and that was 9-8 months in a row. So he dealt with that very well, and his system dealt with that. But at the end of the year, his accounting for the end of the year for 2016, he was quite nicely in profit. Thank you very much, all in the last 2 months. And a totally mechanical, emotion-free, non-discretionary system are the ones that work best. And even you see me comments on Facebook, if you follow me on Facebook, or so every time I fiddle with some of my systems, I end up costing me more often than not. So try and keep it, if you've got something at work, keep it working for you. Okay, so it's all about knowing yourself, knowing the systems, knowing what works for you, and working around your time frame, because there's no point in trying to have a system that's really good at scalping if you can't sit and watch it all day, or you can't get it working for you in that time frame, or you're not designed to be a scalper yourself personally. So it's very much fitting it around yourself. So I hope that was of some use. Let me just click through. So again, any of you that haven't got the app, download our Hot Forex now. Is there any questions before we tie this up today? They're the books I was talking about before. Again, those of you that haven't seen them before, that's the key one, The Reminiscence of a Stock Operator, and the other one is Trading in the Zone by Mark Douglas, another great trading book. Joel's how do you create a trading system? I'll guess is what you're trying to say there, Joel. Well, it's just about finding you start with the indicators that work for you, and then back test them, see how they work. Moving averages are great when for spotting trends. So start with that. Or if you like oscillators more, start with the stochastics or the MACD. Make sure you understand the indicators first. Start with the standard settings and see how they run over time, and back test them. What's the difference between a trading system and a trading strategy? Well, there isn't any. Well, a system is perhaps is an automated system. Let's call it that. Something you might be able to buy off the shelf or create yourself. A strategy is more, I would say, more of an approach, more of a mindset, more to do with your trading plan. To be honest, Nagwash, but there isn't really a huge difference. A system tends to be something that's automated. A strategy is more of perhaps a personal approach. I missed most part of the seminar. Will it record a version? Yes, of course, Odimar. It'll be available for. You'll be sent a link to the recording that I'm going to upload to or the marketing team will upload to YouTube. I've been trading with algo since 2009, and good luck to anyone here who creating their own. It takes years to understand and accept the model. Needs to be as simple as possible. Back testing important, but secondary, use tick data. K&D Investments, thank you very much. At least the beginners. You're absolutely right. Can I read that out again for everybody? I don't know who K&D is here. Sorry, I didn't mean to read your whole name out. I've been trading with an algo since 2009. Good luck to anyone here creating their own. It takes years to understand and accept the model. Needs to be as simple as possible, like I've just said. He's saying that, or she's saying that. I don't know who this person is. And it needs to be back testing is important, but secondary, use tick data. So yes, tick data is basically the live data coming from either the futures exchange or the equity or the central exchange. Certainly for me. Marek, thank you very much for that comment. Yes, you're absolutely right. So 2009, we're now in 2017. That's 8 years. Marek is talking about, and you know, he's been using it and developing, and it's you know, it can be quite difficult. But you know, if you're going to go and buy one, be very cautious about just investing your own money in somebody else's system. The best thing to do is to learn to do this yourself, and the most important thing, like I see all the time, read these books and understand yourself, and understand that, you know, trade with money you can afford to lose. But once you understand yourself, once you understand the markets, it can be a very useful way of making certainly a second income. So thank you very much, everybody. We've got some webinars next week. There's one tomorrow on strategies on over a shorter time frame. Sorry, there were some questions coming in there. Now we're saying, is 1%, well, 12% per annum is 1% a month, isn't that too small? No, 1% a month can be okay, Nagosh. I'm saying a minimum of 12% is what I was saying. That's why I said really it wants to be about at least greater than 12%. So 20%, well, 15% ideally, 20% ideally. But remember, it's the drawdown. This drawdown here, you know, if you're getting 20, trade for 20% maximum drawdown. As I said about my friend who, you know, was out of the money for 2016 before he came across. Is it possible to do algo system from Joe? You can do algo system trading, but you remember true algorithmic system, as I said at the beginning, is really for the big boys, and don't, you know, it costs millions to get involved in that. But there are many systems out there that you can trade on a daily basis, and you can say develop even your systems for yourself. When I say develop systems for yourself, I really mean sort of develop your own mindset, because that's the really key thing. So mindset, discipline, patience, very key to successful trade. So thank you very much, everybody. Kazim, you'll get a copy of the presentation as well. Okay, so thanks everybody. I hope that was useful. Any final questions before I go? We're in 55 minutes in here. No, I'll count you down. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. Marek, that's a very kind comment, given you've been doing this yourself since 2009. Okay, great, everybody. I'll see you all next week. All the best. Take care. Bye-bye.